All right, should we move on to the next company? What are we going to look at here?
I think it's Kraft Heinz is the next one.
Kraft Heinz Foods Company. I mean, gosh, what's going on with them? There's some interesting stories on them, isn't there?
Well, obviously we know that unfortunately Warren Buffett is no longer CEO of Berkshire Hathaway, and there was actually a filing that came out from Berkshire that they registered its entire 27.5% ownership stake for potential sale. Doesn't mean they're selling the entire stake, and my guess is they would do it over time potentially. I mean, if they flood the market with 27.5, oh man, that thing is probably going to come crashing down even more. But what this means is Greg Abel and co at Berkshire may be starting to unwind that Kraft Heinz position.
I know Warren Buffett was not in favor of that. We talked about how things will change, I don't think for the better. Because Warren Buffett, he was upset that they were trying to spin something off and do this. Like, no, just keep doing what you're doing. But let's look at the numbers here for you.
Yeah, well, Buffett said it was kind of a mistake. He was wrong on the merger, but he said unwinding Kraft Heinz is not going to fix anything in his opinion.
Yeah. Well, Kraft Heinz symbol is KHC. They're in the packaged food industry, 7.2% short on the float. Only 61% is institutional owned. No PE ratio. Means over the last 12 months, no earnings versus 19 for the industry. Price of sales, 1.1. That's the same as the industry. Price to book value, 0.7 versus 2.2, but no price to tangible book value, which means a lot of intangible assets on the balance sheet. Price of cash flow does look good, 6.2 versus 10.3. Well, the PEG ratio, I've never seen one this high before, 125.2. That means you're paying a lot for the future growth of this company.
I'm assuming their growth rate's really low.
Yeah. Well, let's see. On the earnings growth, nothing there because they have no earnings, and that's 1 year or 5 year. Sales growth a negative 2.6%. That's not good. The industry's at 4.3. And then the 5-year earnings per share growth from the estimates, or the analysts, is a 0.1% versus 3.6.
That's why the PEG is so high.
yeah, just not a lot there. Now, they do pay a 6.9% dividend. No earnings, so they're borrowing, I guess, to actually pay that out. The free cash flow payout's about 53%.
I do believe then that's write-offs, right? Like if you have free cash flow, the earnings are distorted from something. Yeah. It's not like, oh, this company's losing money. My guess is they had a big write-off, and I think they had to write off like Oscar Mayer. There was some major write-off they had last year.
That's why the free cash flow is so important. That's one big thing that we do look at.
They should converge over time, right? Like if free cash flow is high and earnings are low, free cash flow and earnings, that payout ratio should trend together over the long term.
They should, because eventually those write-offs you had aren't there. So eventually they should come pretty close to being the same. Never completely, but close. Look at the balance sheet. Current ratio 1.1 versus 1.4. Debt to equity looks very good, 0.5 versus 1.6. I do see, here's a problem, 73% of intangible assets on that balance sheet. That is dangerous.
A lot of write-offs.
Yep, a lot of write-offs there. Net profit margin, a negative 17.3. The industry's a positive 4.6. Return on equity, a negative 10.5 versus a positive 25%. Free cash flow, now this does look good though. Free cash flow for Kraft Heinz is $3.6 billion. The industry's at $3.8 billion. So that could be something that makes this company worthwhile. If you look over the history of companies with good free cash flow, they generally do pretty well.
Can you remind me again, what was the debt to equity?
Debt to equity was pretty high. Let me see the debt to equity. Where did that go? Oh, I'm on the wrong page here.
While you're pulling that up, I'll look at the current price here for Kraft Heinz. It's $23.20. The 52-week range has really struggled. The low here, $21.99. The high, $33.35. Over last year, the stock's down 20%. Over the last 5 years, gosh, I mean, that stock is down 31%. And over the last 10 years, it's down 70%.
Debt to equity, 0.5.
0.5, okay.
That's pretty darn good.
Yeah, pretty darn good. The only concern I have is if they do the spinoff, I assume more write-offs are going to continue to come. Now, that gives you, I think, a cushion, right? They're not going to have write-offs, and debt to equity is not going to spike to 150%. So if debt to equity is, let's say, 1 right now, and I anticipated more write-offs coming, I don't think I would touch the stock because that debt to equity could skyrocket.
Right.
But still, they have manageable debt. I think even with write-offs, it'd still be manageable debt. So, I mean, that wouldn't necessarily concern me.
Well, and I think I would almost say I'd like this company if it wasn't for the fact that they want to sell 27.5%. That's not good because any chance they get to unload it, they're going to unload it. They mentioned that. They're going to do it. that's not good having that many sales on a company.
Well, let me give you the current estimated earnings
yeah.
for this company. $2.49 is the estimate for December 2026. I mean, it gives a target sell price of $41.33, trades around 9 times earnings. And to echo your point, I don't think I would touch this business until that Berkshire stake was maybe under 10%. I mean, it's just such an overhang, and it's such a wild card because we don't know the investment philosophy of the new management.
No, we
and
don't.
what is going to happen with that. I mean, they could have loaded it very quickly and the stock could plummet to $15 a share, and that sounds extreme, but I mean, shoot, you got to find a ownership for now 27.5% of a big company. That's a big problem, but I would tell you, if that did happen, I'd be very interested in this company at that level.
You know, just thinking out loud here, because their debt to equity looks pretty good. Could the company say, you know what, we'll buy back that stock and, you know,
Some
and
financial,
hold it?
yeah. I mean, that might be. And you might miss the opportunity, but again, I don't think I'd touch it until there's more clarity on the situation.
Yeah, there's a lot of danger here, but I think some potential. I'm kind of disappointed that they're talking about selling it because I don't think it's as bad as they think it is. And I know he's done terrible since he invested this, but it doesn't mean now it's a terrible price. So, all right, let's